Good afternoon. Welcome to the fourth session under Block 1 under PPAM 003. Today we are going to talk about the product portfolio analysis, which is another very important aspect in the product management system. Product portfolio analysis is one of the most important framework as far as the strategic decisions of a company is concerned. Unless the entire product portfolio is considered explicitly, decisions cannot be taken, or rather we can say we can arrive at suboptimal results of decisions which result in some kind of a problem. So it becomes imperative that in the product portfolio analysis, we look into various indicators like the profitability, the growth potential, the market acceptability, as well as the risks involved in the investments that firms need to take in terms of bringing in new products, making them more viable in the marketplace, as well as looking into sometimes even weeding out the weak products from the portfolio. So to this session, we are going to look at the various matrices which govern the entire process of the product portfolio analysis. But before we do that, we have to take care of three critical decisions that the product portfolio analysis envisages. One is the trend of the business that we are considering for analysis, whether it is at a corporate level, whether it is at an SBU, that is a strategic business unit level, or the firm level, product units, product line level, or product level, and so on and so forth. The second critical decision is with respect to what is the definition of the served market. It may so happen that we are active, the firm is active in a particular market, which could be the part of a total market which is being served today. So what is its implications, and tomorrow if that served market goes through change, what we need to do, look at for understanding the product portfolio. Last but not the least is the time period of analysis. Now, this is the dilemma most of the analysts, product managers, when they're looking at the strategies, grapple with is what is the time frame that they should look into for analyzing the product portfolio analysis. Of course, we do have historical data to substantiate the performance of a product to go ahead. But having said that, there can be certain assumptions in certain contexts which may not be practically possible in terms of the forecast during the decision making period, or there could be some historical data which cannot predict certain upheavals in the marketplace, like something which happened during the COVID times. So one has to understand the contextual issues as well as the time factor while we are going for the portfolio analysis. Now, the purpose of the product portfolio analysis is it's a very simple one, how to allocate resources so that you get the best results out of the market. And of course, this gets into the strategic decisions of a business, because you're looking into your business future. The future of the business is dictated by the portfolio analysis that you need to do. Many different approaches have evolved over the years, which has basically the common objective how to look into an expanded portfolio of products, how to make your product portfolio stand strong, robust, successful, as well as deliver the goods in terms of profitability. So we have to look into those parameters as we are going for the product portfolio analysis. Let's look at the kind of logic that is underlying the portfolio approach. Well, it is based on certain philosophies. So let's look at them. One is definitely the opportunity for the product or the market. Obviously, you know, the opportunities is not consistent across the market or all the products. It differs according to the market conditions, the competition, the attractiveness of that particular area, and of course, we look into the competitive strengths. The product, if you have a good product, it also brings in a lot of competitive strengths and what kind of opportunities that are there. Here, when we talk in terms of the competitive strengths, we are looking at the capacities or that the individual organizations need to have in order to make the corrective investment decisions into the product portfolio. In resource allocation, the third point is the resource allocation decisions. You have to understand the profitability and the growth part of the product very, very critically. Out of which, I mean, without which obviously the strategic decisions cannot be explicitly taken. Next, we should look at the objectives, which would be the objectives of the companies which we are dealing with, as to what are their plans, future plans, and how do you look at the emerging opportunities for their products, and as well as the competitive space, and how are the players coming up, and what is your own competitive strength in those products which you are trying to bring in. So that is another logic that has to be understood while undertaking the portfolio approach. Based on the corporate and the individual product objectives, resources can be looked into for allocation. Well, it's not a very straightforward process. It involves a lot of interactions among the various sources of that we may look into for getting the right decision. Next, we look into the types of tools that we use for carrying out the resource allocation analysis for understanding by looking at the product portfolio. The one of the most very, very common and a very famous matrix that we all use is the Boston, which we call the Boston Consulting Group Growth Share Matrix, or the BCG matrix, if you have heard of it before. BCG matrix, of course, has been developed by the Boston Consulting Group, which looks into the two parameters of the market growth rate, related market growth rate versus the related market share. So we'll come to that in some time. We'll also be looking at the GE McKinsey matrix, which has been again developed by the GE in conjunction with McKinsey to understand the dynamics of whether one should be investing in certain markets, looking into the products which are there in terms of two parameters of industry attractiveness and the competitiveness of the firm. We should look into the third part is the Shell's directional policy, which is again, I would say, a derived kind of a matrix, which looks into more or less looks into a particular advantage in terms of what kind of a policy direction we can get, looking into the competency of the core competency of the firm and the competitive environment in which they are operating, as well as what is the attractiveness parameters. Strategic Planning Institute model, which is also known as the PIMS model, which basically talks about what is the impact of the profit on the marketing strategy, depending upon the profit that accrues from various products which are there in the markets, depending upon the competitive space as well as the attractiveness. The only thing is that we build in a lot of regression, a lot of quantitative techniques to assess, to come to a conclusion as to what is the scenario for the analysis of the product portfolio. Fifth one we'll look at is the Arthur D. Little Companies matrix, which is also known as the ADL matrix, which again looks at these parameters which we have already talked in terms of the life cycle stages of a product, like the embryonic growth and mature, which you have already done in product life cycle, and then how the business strength of a firm should be aligned to that, and what kind of opportunities or what kind of choices can come up as a part to go ahead or to hold or to stop any kind of investments in order to get a decent return from the market. Last, we'll be looking at the Hoffer's product market evolution matrix, which is basically again looking into how across when the product is evolved and what is their competitive position across the various level of PLC. It is also a kind of a kind of, I would say, it's additional work on the BCG matrix. So let's deep dive into what is the BCG matrix talking about. If you see the BCG matrix, it is broken down into two parameters. One is it is also known as the growth share matrix, where you are looking into the relative market share and the relative growth rate. When we talk about the relative market share, it is on the assumption that the relative competitive position of the company would determine the rate at which the business generates cash. So we'll have to understand that the ability of the firm to generate cash in their competitive sphere. If you look into this, the growth rate is associated with the industrial segment, which is associated with a high growth rate, and under that, what is the kind of expansion that you are looking into in terms of your growth. Suppose the growth rate on that particular industry where you are trying, where the product is growing at a particular rate. So we need to we can factor that into our decisions, that whether we should be looking at any investment opportunities there or not. So given these parameters, the business activities are aligned. On the vertical axis, you have something called the market growth rate, and the horizontal we have the relative market share. We look into two extremes of the scale, that's a high or a low, and it is calibrated according to the middle line is, let's say, that is the midpoint, and if you see on the other side, it would be on the when the growth rate falls, it is on the negative. As the growth rate increases, it's on the positive. So as you can see, there are four quadrants which are indicated in the BCG matrix, which is based on this. As you can see, we have shown it in form of symbols out here, but I will just run down that, which is basically the question mark. As you can see in the red here, the question mark is called where the relative market share is low and relative growth rate is high. This is mostly for new products which are likely to come up, new prospective products which are there. It gives a scope for you to get into the market. It is called a problem child, ideally, because we do not know what kind of a trajectory it can take in future. So there are certain things which are associated with it that you do not, there is a unpredictability associated with this particular stage of question marks, and but there is a potential because the growth rate is very high. The relative market share being low could be because of either the firm's competitiveness in those markets could be less because they are either into the market now, or they have not explored the possibilities to expand the market conditions. Going into the other stage, as the firm, as the product starts doing well, it may start increasing their market share in terms of their competitors. They will have better share, and it starts growing, and it may enter something called the star quadrant. The star quadrant perhaps is the most desirable among all the quadrants, as you can see, because it has got a high market share and a high growth rate. What does that mean? Is that in that space, it's a market which is growing, and your market share is also growing depending upon how you are taking decisions to reach out to your customers through your marketing strategies, which help you to reach out to more and more people vis-a-vis your competitors. Hence, you have a star. Now, going to the third one, which is called the cash cow. This is a business where you have relatively low market share, or I would say the highest market share, sorry, high market share, but the growth rates starts, I will not say it is low, but it starts falling. And you will find that in certain markets, if you have a very high market share, but the growth rate is low, initially you may get a lot of money. It will be a cash generating situation, so that's what is called a cash cow. And obviously, but it will not be the story going forward if you stay with this product for a longer period of time, because it is eventually might lose out on the market growth rate, because the market share might drop because of the falling growth rate. As you can see, the growth rate fall is low. So somewhere down the line, it talks about that the product is not clicking or is not able to resonate with the consumers, as a result of which the revenues are not coming. And but the market share is high because whatever sales are coming, it's only generating profits. So it is high. So it is some people also look into that, having a certain amount of cash cow. Now the money that you make here is often used to fund other reorganization within the portfolio. Uh, it is because mostly cash cows are very strong brands, but then slowly they might lose in the marketplace. So there has to be something intervention required. A strategic decision has to be taken here. Going to the dog stage, the dog basically looks into, as you can see, it has got low market usage as well as low in market share. Not a very desirable position to find your products in that segment, because it indicates that the product is not only losing market share but is also not finding enough competition, or even the market growth rate is also not there. So some products may find themselves got napping into this. When, for example, in the technology space, some products may be considered to be obsolete. So during that period of time, what do you do? Would you have it in a portfolio? Most of the time, what happens, there are decisions, as I told you, these analyses are done to take decisions. So mostly if you have products in the dog stage or in this quadrant, possibilities are there that the product lines or the products may be weeded out or may be discontinued in the marketplace. There are various kind of decisions, outcome implications which can also come up, right? So as a general strategy for a company with very diverse portfolio, they may have products in all the four quadrants, and there are certain implications that you need to do. So first is to maintain competitive position up for the cash cows and avoid over investing. Of course, it is good to have cash cows because cash cows give you a lot of revenues. But then you should not over invest in them. You should rather look for new avenues of growth and try to channelize the revenue to other areas of growth. The surplus cash, which is generated by the cash cows, for the period that they are generating positive cash, because whatever money comes in is mostly in the profit zone. So they are good that, but that money can be utilized effectively for pulling up other products which are doing well rather than the products which are going down. You can also look into the funds from cash cows can also be channelized to the problem child, because the problem child stage, if you've seen, and I told you, are the ones which have got unpredictability associated in future. So if the funds are allocated to the question mark, it can help them pick up in the marketplace. So it works as a kind of benefit to look at the resurgence or making your question marks do better in the marketplace, because the growth rate is high, so they have a potential to grow. The other implication is that, as I told you, that as the market slides down and the market share drops, you may have products in the dog stage. So there are two ways of looking at it. Either you can continue with them or you can take them out of the equation. If you want to continue, you need to revamp it, you need to bring out changes. But I will give you an example of a brand called Burnol. Now, Burnol was an antiseptic cream, but it came with a very unique association that it is only applicable in case of birds. At least that is what the brand messages which were going in the advertisements they were talking about. But when the burn incident started falling, the sales revenue started going down, and it slowly moved into the becoming a dog. So the brand was acquired, and today the brand is repositioned in the marketplace as a multi-purpose cream rather than a burn. So there were some changes which were brought out in the product packaging and all that. But yes, it is basically, you can rejig the market, you can revitalize your products and give it bring in innovations, bring some line extensions and put it back into the market so that it can pick up. But when you are doing that, you have to see that you are taking the risk of putting it in a market which is a growing market, not a market which is going down. So that becomes a critical indicator. Next, we move. The BCG matrix is also one of the most important portfolio analysis, but it has got certain limitations also. I will have to talk about the limitations. So if you see the profitability for the growth and market share is, you cannot say the growth comes only from the growth share, the growth opportunity as well as the market share. It does not explain various aspects that goes into achieving the market share. So there are various other factors which need to be considered, just rather than considering market share as a criteria. So we need to look at that as one of the limiting factors. Another thing is even determining the market share. Competitors, who are you competing? When you say relative competition, are you talking about the larger construct, or you're talking about the other opportunities which are there? That needs some kind of a clarity. Uh, in case of the dog stage, you find that most of the products in the dog stage are also ignored. They are products which have stood the test of time, have grown, have been accepted. Maybe they are not being accepted right now. So we need to relook at for reaching in the market. Uh, as regards there's also a certain amount of, let's say, the managers who are handling this portfolio. That human intervention is a very critical factor. What kind of decision that the manager makes for these products in different quadrants is a very important factor. That has been completely ignored. And obviously, we are looking into what kind of changes we need to bring around to make the brand, the utility market share and the growth rate look into little more details. So that is one which has been looked into by various other matrices that we are going to talk about. Next, we move into the GE 9 cell segment matrix, or the G McKinsey matrix. As I told you, this is a matrix which is slightly, I would say, that was a 2 by 2. This is a 3 by 3 matrix, which looks into slightly the broader term, not looking at only the market share or anything, because there are so many other underlying parameters which needs to be looked into while assessing the market attractiveness or the industry attractiveness. And then we talk in terms of what are the competitive strengths of the firm. So let's look into that. First, what comes under industry attractiveness? This includes features like market size, growth, diversity, inflation recovery, technology protection, socio-political risks, economies of scale, seasonality, cyclicity, and barriers to entry and exit. So you can see that when attractiveness is part of a firm, of an industry, plays a very, very important role in all these factors. If the market growth rate is not there, if the diversity is too high, or if you can say that the technology protection is very, very minimal, it is susceptible to legal and political interferences, and seasonalities, and these parameters are there, it may make either the industry less attractive, moderately attractive, or highly attractive. So we have to weigh these parameters in our analysis with respect to a company, to a given industry that the company is trying to invest into. And it helps you to understand the industry dynamics. The second part is the business of the competitive strengths, which means what are the strengths that your company has vis-a-vis in terms of competitiveness of the marketplace. So we look into relative market share, distributor and brand strengths, the technology strengths, innovation that is being practiced, that has been taken out. A profit margins related to your competitors, which are the products which are giving you profits vis-a-vis your competitors, and ability to compete on price and quality, and the knowledge of the customer and caliber of the management. Of course, when you're talking about your competitive strength, you have to understand that what kind of a market share you are looking at, how much is your brand strength, how much you are pitted against your competitors, how deep is the marketplace that you've got, what kind of technology innovation you believe to factor in terms of assessing your competitive strength. So based on that, again, it can be categorized into low, medium, and high. As you can see in the grid here, based on these parameters, the choices are available to a given manager. What you can do is, if you can see that mostly it can be converted into two parts. Either you invest, grow, or you can get into selective earnings, or you can divest. So whether you want to hold your investments, whether you want to go ahead with the investments, or you should not go for the investments, can be easily replicated by the kind of quadrants that your products can be associated with, or the situation is associated with. Needless to say here that the quadrant 1, 2, and 3 are very much proactive because industry attractiveness is high and medium, as well as in terms of the competitive strength. So in terms of competitive strength, though it is low, you can always invest and you can always improve your competitiveness in the marketplace. If it's medium also, you can always improve your competitive strength. If it is your competitive strength is moderate but attractiveness is high, you can also invest. So these three are completely one should jump into in terms of investments. But the segments which are 3, 4, which looks into selective earnings, there is a sense, there is certain amount of sense of understanding what the realities are. You may hold on to that for some time and selectively take a decision. In some cases, you might go ahead with it. Something depending upon your level of competitiveness in the marketplace. In case of your the no-go, obviously you can divest or you can harvest whatever is there and can come back. There are certain long-term perspectives with respect to high attractiveness, moderate attractiveness, and low attractiveness. So one has to look into all these possibilities while you are taking a decision applying this particular matrix. There are some strengths associated with the approach here. Here, as you can see, the multiple criteria are being used, so it gives you more insights into analyzing the product analysis better and help you to take a good business level decisions. And it can be tailor made to the kind of business level or the SBU that is there within the system or associated with the company. And it is not totally quantitative or quantitative. Some judgments are made, so it's a mixed approach, so one can look into an effective way of access and getting the results. Looking into the next most important parameters, that is the Shell's directional policy matrix. So as you can see here, it is almost on the same lines as what it used to be earlier. The only thing is that we are classifying it on the basis of the capability of the firm as well as the segment attractiveness. That means the market which you are trying to look at, and you're classifying and categorize depending upon the company's capabilities, which are basically looking into the strengths in the market position which it achieves, which it has at this point of time. So as you can see here, again 3x3 matrix, which talks in terms of the capability being weak, average, or strong, whereas you're looking at segment attractiveness being highly attractive, or not being averagely attractive, moderately attractive, or being totally unattractive. And what we need to look at is that the business, what we talk in terms of the business trends and the market attractiveness, there are certain things which we need to put that into account. The analysis, according to, if you look into the segment attractiveness, one good thing about this particular matrix is that it gives us a direction in terms of each product or area that the business wants to achieve their goals. And the second part is definitely, as I told you, is the organization's ability to basically look into the opportunities and take it, whether in terms of whether they can go ahead with the investments or not. We also should understand at a strategic business unit level, what does this particular matrix helps us in directional policy. So if you look into the strategic business unit, what is a strategic business? They have some common segments and competitors. So they cater to the market exclusively. They have their own way of learning the system, Like for example, within the Tatas, if TCS is looking into the software market for developing software, so they have a unique, very cut out very differently from the Tata. Yes, they align according to the Tata philosophy, the mission, but obviously as an SBU, it is their market, it is their environment in which they work, and they grow, they invest into that by looking into the possibilities or attractiveness of that particular space. So that is simply put, DPM considers a range of factors while considering the business sector prospects. Sorry. One is definitely when you look into the business sector prospects, we look into the market attractiveness, we look into the market per se, the competition that is there, what is the level of technology that is involved in this, in that particular product range that you want to bring in, and what is the economic parameter that you leverage, whether it is can be really, what are the margins, what is the ROI that you can calculate from that. Obviously, we look into if there are government policies which help us achieving their objectives. So that's another area which we look into in terms of market attractiveness, which comes under business sector profits. And we also look into the social availability, the social parameter of the market, which includes people, includes trade unions, and so on and so forth. And last but not the least is the location, the geographical significance of the market. Is it accessible, or it requires a major investment in that. Going on to the competitive abilities, look into market, the share, what is the market like, what is the growth prospects, what is the pricing ability, what is the marketability of that particular company, can we get into it, technology skills that are required to enter that market, and of course the production, the people, and the financial might of the capability of the organization. There are a few choices, as you can see here, that a few implications which come out that during the segment is attractive, we can get into higher cash generation, we can be growth leader. So you'll see that across if the strong segment attractiveness has been unattractive also, if your capability is good, you can always go as a prospect and can generate cash out. So it talks about the potential to grow that particular segment because it's a very attractive parameter. Looking to growth leader, you can become, if it's a moderate, you can always be competitive. If you're good competitive, as you can see, your capability wise, your capabilities are good. So you can always enhance the your leadership in the marketplace. And the leadership, obviously, question is the more desirable thing to get into. Average, yes, you need to have, you may have a phased kind of withdrawal. It's not very generating enough cash. So if it is not, it is attractive, but it is not in an average, you can go for a kind of a staggered way of withdrawing from the market. But obviously, you will not immediately run out because there's still some potential. If it is an average and it's unattractive, obviously you try harder to be, but then obviously it might be a difficult proposition to sustain in this business. Custodial business would be an average, so you can be there and there for some time, and then you can often come out of it at some point of time. If it is a weak, in terms of the problem starts if your capabilities are weaker, but the attractiveness are there. Of course, when it is unattractive, there is no point in being there, so you need to disinvest. Phase withdrawal if you are in a moderately capable but in a average attractive quadrant. You can, if you're in attractive and you are very strong, but your capabilities are weak, you can milk the market and can get out of it. Which means what, your products which are there, which are doing well, try to get as much as possible, but your capability is weak, so as much as possible you can take it and get out of the marketplace. So this is what is there with the directional policy metrics. Next, we move into the profit impact of marketing strategy model. Here, if you can see the others, mostly it is built on the same line, but the only thing is that here there is a statistical relationship with the what you have done in the past, and instead of making some judgmental parameters of market attractiveness and competitiveness, here we look into the a data kind of a requirement, a data which has been used, statistical data which is used for carrying out your these objectives. for analyzing the market situation. Next, we move into the Arthur D. Little companies, or which is called the ADL companies matrix. As you can see here, in this matrix, again, it has got a very strong relationship with the various stages of the product life cycle and how it is being mapped to the business strength of the organization. So on the vertical, you will find that the businesses are classified with respect to the weak in terms of their ability to get the results as weak, tenable, favorable, strong, or dominant across various stages of the product life cycle. So if your competitive position is dominant, so we can see here all are push per share and hold position. So hold is the most common thing if you are in a dominant position in terms of your competitive capability. If you are strong, then also you improve your position to maximize that return from the marketplace at different stages. Obviously, as you are aging, obviously things would be a consideration whether you want to hold or you want to harvest further. If it's favorable, you can go selective in terms of your in the introductory stage or the embryonic stage, because you may not get the returns initially, but as you pick up, you improve and go for it. And you get custodial maintenance. That means what you need to basically look into at the maturity stage. If your competitive positions are favorable and you are fairly competitive, what you can do is you can find some niche and try to protect it. Some areas may not be detrimental to you. You may get out of it. The last, in the aging phase, obviously in favorable thing, you can harvest and continue to go for a phased withdrawal from the market, because coming beyond the aging process, things might go out of and your favorableness may not last long. So you can go for a selective withdrawal process. Going to the tenable part, when you're looking at the tenable part, we are looking into selective, becoming very selective across all because you do not know how your competitive position may work out. So you may consider being very selective to be in that space. You may go in for a niche market, you may not go for the whole market, go for the niche and fail and slowly phase it out of the market. If you're in a week, obviously in the running you are out, there's no doubt about it. But in the growth stage, if the products are there, you can always think of making a turnaround. You can take some revitalization strategies and work it out. But most less, if you're weak, the idea is not to go for further investments into this. Try making more out of whatever is existing, and because the ROIs might drop, you may have to get out of this. So mostly in the if you can see in the for mature market businesses, dominant, if you're in the mature markets, obviously you'll find that the dominant position is to hold and make most out of it. As you move down to the aging part, it could be harvesting or going for a phased withdrawal from the marketplace. Now, unlike other product portfolio analysis, this is based on applicability, where it fits to all type of situations of competition. So if you can see the 5 stages which have been given of competitive position, it gives you a certain amount of flair as to what kind of options are available to you in terms of your competitiveness in the marketplace, and it is more applicable in the marketplace. It is one of the ways, obviously, where it requires an amount of adaptability to the market conditions. So there is a lot of qualitative analytical analysis that needs to be done before we get into applying it in the real sense. Another weakness is with this is that there's a high level difficulty in terms of objective evaluation, because we need to have a clarity and in terms of what is the objectives at different stages of the industry life cycle stage. Here also, it may so happen due to human element intervention, qualitative assessment of situations might lead to a kind of a scenario where there could be a bias in understanding market conditions and taking a decision for the portfolio. So as we move further, One of the key factors which I forgot to tell you about in terms of the ADL is that it's a far more clearer and more diversified. It gives you more opportunities to look at your competitive strength because of these higher level of competitive positions that you have identified to give you what kind of possible solutions you can have. So that is something very good. So it helps you to take decisions which can be spread across all your product your product categories and help them to stay and harvest or go for investment decisions. So it is more holistic, I would say, in terms of the applicability. Next, we move into the half a product market evolution matrix. Now, this model is a evaluation of the product life cycle, which we have done in the past sessions, and also evolution of the market in terms of the competitive positions. So it has something like some 15 cell matrices which are based on two bases. As you can see here, the first one is the product and the market development, growth, shakeout, maturity, and decline, which are the various stages of the PLC, as you can see. And the second one is the competitive position of the firm. So when we talk about competitive position of the firm, we look into three parameters: whether your competitive position is strong in that particular area, whether it is the average or it is a weak competitive position vis-a-vis your competitors. As you can see here, we look into the various here A, B, C, as you can see, are represented as the various SBUs. If you look into the kind of the largest circle, it talks about what is the competitive position, and of course, when you look into the it represents, of course, and there are pie wedges. You can see those dark wedges which are there, which represent the market share of the business unit, whereas the circle represents the total industry. So it gives you a comparative figure as to where you stand in terms of your competitive position. So you can see wherever the wedges are high, you will find that the chances of your when you are in a competitive position being either strong or average. Now again, that is juxtaposed against the various industry stage with your product life cycle goes through. As you can see, from the development to growth to shakeout to maturity to saturation and decline. It is a little bit more intertwined into the marketplace. As you can see, most of the A's has a competitive position in the development stage, and obviously it holds out prospect for the future development. If you look into the B, let's say the SUV B, which is shown in this slide, you will find that it has got a strong competitive position in the growth market. So obviously, again, you can adopt various growth strategies to make it a future winner. However, the SBU C is the competitive position of the firm is less. So obviously, in that case, though it is in the growth, it is weak. You can look into a careful formulation of marketing strategies to be more competitive, given that you can there is a possibility of, because it's in the growth phase, so there is a chance that if you invest effectively, it can come up, but that depends on how competitively your resources are allocated, how your resources are being allocated. Going to the SBU, which is D and E, which is into shakeout and maturity. It's moderately strong, I would say, in the shakeout space, but it requires closer attention in terms of the way forward, because you are into a market which is likely to give you challenges. Going into the saturation, obviously the market saturates. So even if you have the market share which is higher, competitive position is good, try to make as much as possible. So with E and F, there's a caution that the market is maturing and you have to get back as much as possible. As per when you go to the F, you have to be very clear in terms of there are no funds which are going to come which can be invested here. So as you move into saturation, the funds capability of the firm is less. So we need to hold the market position without fail, and then and should not invest more. Decline phase, obviously you need to either get out of that particular situation, because that helps you to at least consolidate whatever money you are there, make so it is like milking the cow, making as much as possible, and then you can get out of it. Now there are certain variables that one has to look into in terms of the the Hofer matrix that we are talking about, which actually makes this particular matrix a little bit more robust. If you look into the variable A, one which you talk about, variables are like market and consumer behavior variables, like the buyer needs, purchase frequency, buyer orientation, market segmentation, things which you have learned in marketing becomes very, very critical while you are using this particular matrix, because these are built into the system while you are looking into the investment decisions. The industry structure is the next variable, where you look into the uniqueness of your product, the distribution cost, the technology, what kind of products, what are the barriers to entry, what has been the experience curve. These are the few things which we consider under the industry structure variables, and also the degree of product differentiation. The third variable which we normally look into from the competitive variable are like degree of specialization within the industry, degree of seller concentration, and the degree of capacity utilization and aggressiveness of the competition. So from the competitive scenario, it is looking into every possible angle. If you're looking into a supplier variable, we're looking at the degree of supplier, what is the intensity, what's the bargaining power there, and what are the changes available in the raw materials. This has been factored in to assess your competitive position. The other variables which you look at is a broader environment, which is very, very consistent with today's philosophy that, okay, how sensitive are your products in terms of the looking into the environmental variables, which are like the what is the age-wise distribution of the population, what are the life cycle changes that are taking place, what is the kind of productivity or the consumption patterns which are happening, and how is the product, what are the interest rates, what is the money supply to the equation. That helps you to understand whether if you go out for investment also, will you be able to generate revenue, let's say through an IPO, for example. If you want to expand, would you like to get it, will you get a support. Organization variables like obviously how the organization looks into the competitive position in terms of the future, in terms of their allocation of funds and degree of customer concentration, how they are having the market value proposition worked out in terms of their market planning, and of course the market share, which is a critical indicator of the profitability as to what is their market share currently that they are into, and how what is the position. As we talked about competitive position, a strong, average, weak. We say that where is the intensity? Are they very strong on product? Are they strong on, even if you have a product, if you are very strong on communications, if you are into distribution might, you can make things better than your competitor. As a result, you can make better returns to your objectives. And of course, if you have a good, robust R&D, it also beefs up the quality of your products that you want to bring it into the portfolio. So these are the few things which looks into the robustness of this particular matrix. It has got multiple activities, not only in terms of decision making, in terms of competitiveness, but it scans across various things in terms of, if you see the value chain, we're talking about the procurement policies, the value chain in terms of support variables, which we talk in terms of the infrastructural requirements, manpower requirements, the decision to integrate forward or backward or to value add the services. So it gives you several amount of potential based on these analysis, and firms can benefit out of this particular uh, metrics. Of course, if you look into production scheduling, inventory management, there can also be an added thing in terms of how do you leverage on your capacity utilization, whether you are operating at an optimal level or you are looking into a kind of a sellout. Uh, as we already told that when you look into market shares, then into behavioral patterns, you can define the customer segments well, identify them well by application of this particular tool. In terms of standardizing product design, we can look into what kind of raw materials, in terms of quality, how we can do vendor management in order to be to rope in better quality products into the system. So this has got a very strong the offer product man evolution, and it is something which is transitory. It looks into how the market evolves based on the competitive positions can be worked out. So these are few display which we talked about, the analytical models which we have been used. We've gone through 6 of these models, but each of them has its own significance, has its own importance for a product manager, as it gives the framework for analyzing mutual compatibility of diverse operations within the organization. For any company, the portfolio analysis plays very important role in terms of achieving their stated objective goals, organizational goals. So how you are looking into the individual products, how they would grow, whether you would grow them, whether you would nurture them, whether you would hold on to them, whether you want to harvest them, or whether you want to delete them from your entire offering, the bag of offering that you have, would talk in terms of aligning your resources, in terms of value additions, in terms of technology, in terms of infrastructure, in terms of manpower, so which can be aligned to give you better results in the market. Each of these models that we discussed here have their own significances. We need to fine tune in terms of which one best fits to the capability of the organization and the attractiveness that is there in that particular space. With this, I would like to end today's session. Thank you. Sorry. ମୁଁ ଏଇଟା କହିଲି ଦେଖିବାକୁ ଭୁଲିଗଲି ଗୋଟେ ବେଳେ ମୁଁ ସ୍ଲାଇଡ୍ ଗୁଡ଼ାକ ଦେଖିଲା ବେଳକୁ